Hello and welcome to the second episode of Season 12 of the Dark Money Files, in which we shine a light into a murky world. I am Ray Blake, and with me is my co-host, friend and business partner, Graham Barrow. Hello, Graham.
Hello, Ray.
Graham, new year, still a new season, but the same threats exist in onboarding and managing UK corporate relationships.
Well, yes, they do, Ray. And Risk Alert 247 is working and is online in a number of banks and other institutions, making a big impact on defending against those risks.
And if you want to know how Risk Alert 247 can do the same for you, get in touch and we'll be pleased to organise a demonstration for you. It'll take half an hour to show you the system, and there's no commitment to go forward.
Not at all. So, 2025 is still young, unlike me.
Oh, quite.
Yeah, I'm feeling old today, Ray, but there you go. But there's lots coming out from the FCA, isn't there?
There is, and that's a good topic for this first episode of the new year, I think. Any particular paper that you like the look of?
Well, Ray, shall we go with the paper about money mules?
Yeah. Now, this came out a couple of weeks ago, entitled Firms' Use of the National Fraud Database and Money Mule Detection Tools.
Ooh. So, I think some definitions of terms to start with. Right. Money mules we've looked at before, of course. These are the people whose banking and payment facilities are abused by criminals in an attempt to disguise the movement of criminal funds.
Yeah, so typically a mule might allow someone to park money in their account briefly before moving, say, 95% of it somewhere else, perhaps right across the world, on a trail that will ultimately get the money, or most of it, back in the hands of the criminal.
Yeah, and that 95% figure suggests that this is very much a commercial arrangement, Ray. The mules know what they're doing.
Well, they may do, Graham, but it's likely, particularly if they're vulnerable people, the very young and the very old, for instance, that they're recruited with assurances that this is a simple, legal and risk-free way of earning a little easy money for themselves.
Yeah, and is a mule always going to have a personal account, or are there business mules accounts too, for example?
Well, most are going to be personal because there are simply more people. But business accounts are often set up by criminal networks, specifically to act as their mules.
Right, so I think we understand mules then. What about this national fraud database? I mean, that sounds like a good idea.
Well, it is, Graham. It's operated by CFAS.
And what does CFAS stand for?
Oh, it won't stand for anything, Graham. They're very clear on that.
Very good, Ray. And I suppose I asked for that, but you know what I mean.
I do. CFAS is the Credit Industry Fraud Avoidance System. It's an independent, non-profit organisation whose primary purpose is to maintain this database.
Yes, and it gets its data from firms who are members, which is pretty much everyone in UK financial services.
Well, yes, Graham, if you take the definition of financial services quite loosely, that is, because it also includes telecoms firms and public agencies, as well as credit institutions, insurers and so on. In all, it's got over 750 members.
Right, OK, well, I've got that. So what's the score then with the database? What do members get out of it?
Well, it's been seen as a model for the new data sharing powers in the Economic Crime and Corporate Transparency Act, although it predates that legislation. Member firms report to CFAS when they identify a case of fraud. CFAS can then place what they call a marker against the client's name. Other CFAS members can then check names of their potential new customers against the database when onboarding, for instance, and see any markers that have been added to that person's file.
OK, so if I'm onboarding Ray Blake, for example, I can find out, for instance, that he lied to another company last year about his earnings when applying for a loan.
That's the idea. Or you could find out that this Graham Barrow, who seems pretty kosher on paper, was identified by his last bank as a money mule, spraying the proceeds of crime all over the world.
Gotcha. Well, or rather got me in this instance. Or got both of us, in fact.
Yeah, and that's the idea. It's information sharing. Members all benefit from the intelligence gathered by all other members.
I think we should be clear, Ray, at this point that we have just made up those last two examples, just in case people are worried that we are actually criminals.
Well, if you think that's necessary, absolutely.
You never know. Somebody might drop in and listen and think, oh my God, these criminals are doing a podcast.
Well, absolutely.
Well, anyway, let's move on. Now, in theory, that's great, but I can see risks here, Ray. What if you get blacklisted unfairly?
Fair question, Graham. A few points here. Firstly, you have the same rights as an individual as you do with a credit reference agency or anyone else holding your personal data. So you can make a subject access request and have the opportunity to challenge any data, or in this case, a marker.
Okay, but you would need to know it was there first, of course.
Well, that's true, but presumably you'd been declined services somewhere and that would tip you off.
And speaking of tipping off, how does reporting to CFAS compare with reporting to the NCA with the SAR, for example? Is it the same? Do you have to do both?
Now, okay, so here's where it starts to acquire a bit of nuance. Firstly, there's no legal requirement to report to CFAS, although, of course, there is to the NCA.
Right. You don't need to have any evidence or proof to support your suspicion to have to report to the NCA, do you?
No, and that's certainly not the case with CFAS. An unevidenced suspicion is not enough to report a case to CFAS, who require a higher level of proof.
And I think as someone who engages as a customer in the financial services industry, that actually is a good thing.
Well, I agree, but it does mean that as a firm you might end up having enough suspicion to issue a SAR, but not to lodge a report with CFAS. And of course, that's going to be easy to apply inconsistently.
Yes, I can see that.
And that's one of the things that the FCA found in reviewing firms' use of the CFAS database. Considerable inconsistency in the reporting to CFAS of mule suspicions.
All right. How inconsistent?
Well, let's take a firm's population of mule accounts that were off-boarded based on the indications that those accounts were engaging in muling.
Okay.
The FCA cites one firm as reporting only 6% of its account off-boards to CFAS, while other firms were reporting 2/3 or more.
Now, it seems reasonable that not all of them are reported. Sometimes you might not determine that there is muling, but we'll be happy to off-board anyway, given other commercial reasons or what else. And then you wouldn't necessarily meet the evidence threshold for CFAS reporting.
No, but for that to be the case 94% of the time seems a bit of a stretch, doesn't it?
Yes, it does, actually, Ray. Yeah. So why would a firm not go the extra mile and do the paperwork?
It's a fair question. The FCA says that it found a small number of firms which were using the database to screen new customers against, but not contributing any of their own data.
Oh, dearie me. And actually, I guess the draw of CFAS membership is to benefit from all the contributed intelligence rather than the ability to contribute your own. But if everyone went in with that approach, there wouldn't actually be any data to share.
The FCA looked at some of the cases where firms had off-boarded mules but had decided not to report the case to CFAS.
And Ray, what did it find?
That in about 1/3 of cases it didn't agree with the firm holding back. The FCA thought there was enough evidence to pass the threshold and report.
So what was going on there?
Well, reading the report closely suggests that there were two drivers behind this. One was that individual decisions were being made and people's judgments differed. Frustratingly, though, the rationale behind the judgment not to report was often not recorded by the firm.
Well, imagine that. Right?
Well, quite. But also, the FCA noted that some firms had resolved at a policy level that certain types of case would not be considered for filing.
And what sort of cases would those be?
Well, examples seem to be where fraud was only attempted, or where certain age groups were involved, where certain minimal amounts were involved, or where the muling was not first generation.
Now first generation muling is where money is received straight from the crime that earned it, whereas second generation muling would be subsequently passing on the money from those first generation mule recipients.
That's right, Graham. The FCA seems to believe all these distinctions should be disregarded, that any case that meets the standard of evidence should be reported to CFAS.
So then we'd be just down to the individual judgment point, and there always will be individual judgment, obviously, but it needs to be consistently supported with written rationale.
Always, Graham.
Now, we've been talking about this threshold standard of proof without actually addressing what that entails.
Yeah, that's true. And the FCA does mention some issues of difficulty around this.
Okay, I looked at that, Ray. Firstly, the FCA notes that firms often need to rely on the sending institution to respond to a request for information so they can progress fraud investigations, and that sometimes this yields a slow response or no response.
And there's not much you can do about that.
No, but it's worth bearing in mind that the FCA has clocked this as an issue and that we can expect them to be looking at how firms respond to received requests for information.
Good point.
One of the requirements for meeting the filing standard is that you can demonstrate that the customer participated willingly in money mule activity. If they were an unwitting mule, that doesn't meet the evidence standard for CIFAS, does it?
Although it does for the NCA.
Well, yeah.
So on this point, how does it tie in with those characteristics that make customers vulnerable?
Well, that's a good question, Ray. I mean, criminals exploit the vulnerable, and banks and payment firms are sensitive to this. However, not everyone with vulnerable characteristics acts unwittingly.
No.
And the FCA implies as much, that the fact that a customer is vulnerable should not prevent you from reporting to CFAS where your investigation has concluded that they were witting participants in the muling activity.
Makes sense.
So for this piece, the FCA has some concluding thoughts that concern wider fraud data sharing. Now, they say that since CFAS is confined to confirmed fraud cases, it doesn't allow firms to share pure suspicions. The FCA is supportive of other means of sharing this data and invites the industry to innovate in this regard, no doubt using the new ECCTA, the Economic Crime Corporate Transparency Act powers, as more guidance on them comes online.
Yeah. So that's at the data contribution end of things, Graham. I know you looked at the other side, how firms are consuming the database information.
Yeah, as did the FCA, Ray, not so surprisingly.
Yeah. So how typically do firms use the database as consumers of information, Graham?
Well, for the most part, they screen names against the database as part of the onboarding process.
Which seems reasonable.
Yes, many firms also periodically screen existing customers against the database.
Yeah, you mean as part of a periodic review?
Yes, as well as when they have reason to review a relationship because of, suspicions that they arrive at themselves. So we've seen indications that there may be a problem with this customer, and has anyone else found the same thing?
So wouldn't it be useful to have a proactive alert when the CFAS database adds a marker?
I imagine it would, Ray, but the FCA notes that it found only one firm that has real-time alerts like this set up.
Now, I can see why you might worry about false positives, but given the evidence criteria for adding a marker, you'd think that wouldn't really be a justified concern.
I completely agree. I think this is something firms might want to consider introducing.
Is there a danger that this might prompt the kind of de-risking that ends up with unbankable people?
Yes, there is, and I think firms should use a marker as a prompt to conduct their own investigation, not instead of conducting one and just offboarding them.
I think that's really important, Graham, and I know regulators are worried about driving people outside of conventional banking channels.
Yes. So finally, what are these money mule account detection tools that the FCA includes in the report?
Well, it's odd, Graham. At times in the report, it seems like they're talking about a specific tool, but at others, they seem to be using the term generically. I've not been able to identify a specific product, particularly not one that was available in the period under scrutiny, which is 2022-23.
Okay, so we're talking then about a tool that highlights possible mule accounts based on the movement of funds into and through them.
Yeah, and these seem to work just like any transaction monitoring tool does. They'll produce alerts that the firm will then have to look at alongside other information that they have to decide whether the activity is indeed indicative of muling or whether there's some legitimate reason for it.
And just like any transaction monitoring, you have to understand that the rules and thresholds you establish are reflective of your business and its risks.
And here's where the FCA has some observations. They encourage firms to look closely at where those thresholds are set, and in particular, how the rules treat first generation versus later generation mule activity. The latter tends not to be treated with the same level of concern, despite often clear muling indicators.
So what might some of those indicators be?
Well, nothing you wouldn't expect, Graham. The FCA cites unexpected or unexplained deposits into the account, rapid dispersal of funds received into networks of accounts, international movement of funds, and rapid withdrawals through ATMs. It says that where firms look for this through their rules and act on it promptly, they're well positioned to address the risks.
But there's a caveat, isn't there, Ray? And that's the quality of the investigation that the firm undertakes and the extent to which it results in good judgments and documentation.
Yes, now that's something the FCA seems quite critical about in this paper.
And they go further, don't they, in their additional findings?
They do. What caught your eye there, Graham?
Well, the regulator starts by saying that in the review they found a number of transactional patterns that firms should identify internally without having to rely on external data or alerts.
Like what, Graham?
Well, like customers receiving large deposits in new accounts that are a big chunk of their stated annual means.
Well, that makes sense. And firms are urged also to have clear sight of the nature and purpose of any account to be able to determine unusual patterns.
I can't believe this is still an issue in 2025 because my goodness, how often have we spoken about that over the last decade or more. But it seems some firms are not routinely holding this data, nor in some cases annual income or turnover.
Which leaves you clueless when trying to decide if a pattern of transactions is likely legitimate or suspicious.
Yep.
OK, so anything else firms can take from this paper, Graham?
Well, yeah, I think there's one very important point, Ray, and I'm going to quote directly from the final section. After it talks about further engagement with the firms included in the study that led to the report, they say, quote, "We expect all other payment service and account providers to consider their own systems and controls against our findings. It is vital that firms have a proactive approach to identifying and swiftly remediating any weaknesses in their response to tackling the risks posed by money muling."
So then I think that if you've yet to identify a thematic review for the current quarter in your compliance monitoring plan, there's no need to look further.
I think I have to agree with you.
Yeah, excellent. So, what's next for us, Graham?
Well, Ray, we've both got a few conference and seminar appearances coming up. Some quite exciting developments I'm sure we will talk more about later. And these are both together as the Dark Money Files and individually. So I suspect we'll have a few things to bring to the podcast audience coming out of those.
I'm looking forward to it.